Hi, I'm Lauren Taylor, Managing Director of Active Property Group. Today I want to speak about the risks and rewards when investing in a pooled mortgage fund. Like any investment option, there are always risks involved. When weighing up the risks of a pooled mortgage fund, you should take into account your personal situation and your appetite for risk. When it comes to risks, the most obvious one when investing in a mortgage fund is the risk of borrower default. However, there are a few things we do at APG in order to mitigate this risk. The first and most important thing is that all loans are secured against Australian real estate. So if a borrower goes into default, we are able to take possession of the security property, sell it, and recover the cost of the loan and any interest owed. The risk is that this can be a lengthy process, which can be drawn out if the borrower doesn't cooperate. But this risk is again mitigated by being invested in a pooled fund, because even if one borrower is in default, if the others are still within the terms of their loan, then you'll still be receiving interest from those borrowers. At APG, our pooled fund is invested in around 30 different loans at any one time, so the risk of default is spread across the entire portfolio. One thing worth mentioning is that sometimes a borrower going into default can actually be beneficial to investors because the borrower is liable to pay higher interest for the period that the loan is overdue, which can provide a nice little boost to the returns of the fund. Another thing to consider with mortgage funds is whether the fund is invested in first mortgages or second mortgages. In terms of risk, investing in first mortgages offers less risk but with a lower return, whereas investing in second mortgages usually has higher risk but with higher returns. At APG, our pooled fund is invested in both first and second mortgages, with the majority being first mortgages. This means we can minimize risk but also provide the higher returns that come with second mortgages to our investors. Another risk that's worth considering when investing in mortgage funds is the risk of property prices falling. As the loans are secured by property, if a borrower went into default and property prices had fallen, then there is a risk that recovering the value of the loan might not be possible when you sell the security property. The way that we mitigate this risk is by using conservative loan to value ratios. All the loans in the pooled mortgage fund portfolio have a maximum loan to value ratio of 75%. This means that if the loan is secured by a property worth $1 million, then the absolute maximum we would lend is $750,000. And usually we would actually lend a lot less. This gives us a decent leeway to be able to recover the full cost of the loan and any interest owed, even if the property price has fallen. Now let's talk about the rewards. Pooled mortgage funds offer attractive returns to investors that are usually between 4 to 5% higher than the cash rate set by the RBA. For the 2024 financial year, the APG Pooled Mortgage Fund delivered a 9.84% return. Pooled mortgage funds are also a great way to set up a passive income stream. At APG, you can choose to either enjoy your quarterly returns or reinvest your distributions in order to compound the interest and grow your wealth. They are great for people who don't have time or energy to actively manage their investments and are happy to rely on the expertise of the fund manager. And lastly, they also don't require that you be locked in for long periods of time. At APG, we offer redemptions on a quarterly basis. Hopefully this video has given you a good idea of the risks and rewards when investing in pooled mortgage funds. If you have any questions, then please contact our investor relations team at investorrelations@activepropertygroup.com.au. Thanks for watching and see you next time.